Um, Apologies. It seems like on my side, it's just showing that we're only now starting. Sorry about that. Good afternoon, attendees. We're quickly moving on to Series B of the debrief sessions. And this is in respect of solution rooms 4, 5, and 6. We're going to hear firstly from Chanel Bomorski, and she's going to give us a summary from solution room 4 on sovereign credit risk, the reality versus perception. Chanel, without further ado, I hand over to you to give us that summary. Thank you.
Thank you very much, Mr. Maharaj. Thank you, everyone attending. And I'll jump right into it. We looked at sovereign credit risk and whether retirement funds should worry about managing sovereign credit risk in their investment strategies. What we first did was we defined what sovereign credit risk is as the ability and the willingness to not only repay the capital amount owed, but also the interest rate on outstanding loans. We focused a bit on credit ratings and downgrades and the impacts that they may or sometimes may not have on investment markets. We looked also at how retirement fund investors actually gain exposure to sovereign credit risk, being either, number one, directly, so that's directly holding certain instruments in different countries. The indirect method is more to do where you have a listing of a certain investment in one particular country. You often also gain indirect exposure to different countries' sovereign credit risk purely on the operations of that country. And the example we made was MTN, where it's listed, the instruments are listed in South Africa, but they are exposed to sovereign risk in Nigeria due to the operations there. We also spoke a bit about home country bias, basically being an investor domiciled in a specific country. Often you find yourself heavily invested in your home country, and that home country bias, where you are then exposed to the sovereign risk of your particular country. We spoke about the actual events of credit events happening, so that's the default on certain instruments, but we also discussed the probability of these credit events actually occurring, and that the probability of a credit event occurring is often what moves the market long ahead of the time that a credit event actually happens. So often when you find a credit event happening, that's probably already been priced into the market. So as investors as investors think about the future, and they often price events long ahead of when the actual event happening. And then we also had a brief discussion on external debt versus internal debt, where countries have debt which is not domiciled within their own country, and finding purely because of exchange rates, they often find it more difficult to repay loans which is in a different currency than your own. We also did. We also had looked at the opportunities which portfolio managers have when they look at sovereign credit risk and really sovereign credit ratings, and the fact that no two asset managers and no two people really look at the same event and maybe rate it in the same way, which provides pricing opportunities and advantages for an investor to be able to turn the perceived risk of sovereign credit risk into an opportunity for that particular investor. We also did touch on the proposed solutions that retirement funds could consider to try and better manage sovereign credit risk. Some of these solutions, first and foremost, is diversify, diversify, diversify. So where you have diversification between countries, so you can consider not only holding sovereign bonds as it may be in one country, but in a basket of different countries. Where you are not able to diversify between countries, you may look at within the yield curve or within the interest rate yield curve, you may look at diversifying between the instruments of the credit holdings you may have. And then as a retirement fund, always looking at diversifying between managers. As mentioned, no two people really think the same or act the same. So spreading that risk or perceived risk amongst both country instruments and your managers may be a good way of addressing sovereign credit risk. Then delegating the management of your assets to asset managers who look at this on a constant basis and make calls on behalf of the investments of a fund or an investor. And then understanding how your asset manager does what they do and what the sovereign credit risk or exposure may be to a particular country. And then, as always, taking a long-term view on all investments, as our investments tend to be of a long-term nature. And with that, Mr. Maharaj, that was what we discussed. Back to you.
Thank you so much, Chanel. Much appreciated. And thanks again for the summary and very interesting ideas put forth in Solution Room 4. Attendees, please, if you have any questions or queries to raise with Chanel and the team that discussed that, please do so. As I said in the chat, you can either write your question out in the chat box, or you can raise your hands and our admin team will unmute you to then for you to then ask those questions. Chanel, thank you again. I'm going to quickly move on to our Solution Room 5, at which leveraging alternative investments as a tool for impact was discussed by the speakers. I'm going to hand over firstly to Tanya to lead us through a summary for Solution Room 5. Tanya, over to you.
Thank you. Thanks a lot. So this Solution Room, we had presentations from Old Mutual Alternative Investments, and I spoke about our approach to managing risk on the one hand and enhancing positive outcomes on the other, using a fit-for-purpose ESMS for each of our key competencies to integrate ESG into the investment lifecycle, using the UN's Sustainable Development Goals, the SDGs, as top-line goals, and then selecting which ones we feel that we can influence, given our current and most likely future assets, and focusing on those. And then the fact that there are a few of our competencies who would hone in on other goals like quality education for impact funds and affordable and clean energy, given the participation of AIM, the infrastructure arm. And in terms of impact measurement methodology, using the theory of change approach in determining impact measurement metrics or KPIs and then tracking those across our portfolio to demonstrate impact. We talked about data gathering and data management as central to evidencing our progress against our goals and targets. And then the last piece of the puzzle being reporting. And so highlighted our 2020 sustainability report, which is available for review. And we had a poll in the first presentation, and interestingly enough, 45% of the audience said ESG and impact form an integral part of their decision to invest, and that they monitor performance against specific targets. 35% said they had a policy in place, an ESG or impact policy, and they actively monitor performance. And then 15 said it's ESG forms part of their due diligence, but they don't actively measure impact. And the last one, thankfully, 0% said they don't consider ESG as part of their portfolio allocations or performance at all. And then Shanine Williams went into talking about Shanine Williams from AIMS talked about our perspective on infrastructure and the focus areas being digitization, electrification, and energy transition, as well as urbanization. And she talked in more depth around the theory of change and how used an example of a renewable energy facility and how KPIs are tracked, and how they can be aggregated across a portfolio. We all had another poll during that presentation, and that was around the most important impact measure considered by the audience, and it was ranked as follows. So the most, 23% said infrastructure, 22% said job creation, 17% said transformation, 15% said climate change, 11% said education, and 9% said gender equality. So definitely, yeah, a good spread of our focus areas as well. And then Helen Tregurtha presented a case study on clean energy impact as a result of our participation in the REAP program, and the kind of cumulative impact of that group of assets. And then delve deeper into the impact of a particular solar farm, Racer, and as well as their social economic development and enterprise development spend. And she highlighted the Streetlight project. And then we went on to Etienne de Kock from our impact funds, and he gave a overview of impact investing being about two things: intentionally delivering a social impact and also risk-adjusted returns, so having a dual mandate. And he talked about the importance of managing and integrating ESG, having a well-structured framework, having a well-structured framework also for measuring and reporting on your impact outcomes. And Etienne mentioned that according to GIN's 2020 annual impact investor survey, impact investments are made across a broad spectrum of investments, so including renewable energy, infrastructure, financial inclusion, housing, education, healthcare, sustainable forestry, sustainable agriculture, and quite a few more. And that 2/3 of impact investors target risk-adjusted market rate returns. 88% have either realized or exceeded their expectations in terms of returns. So this idea that you are foregoing returns if you're investing in impact funds is a fallacy. And then also reflected that 2/3 of impact investing investments are made through a fund or asset manager. That's kind of highlighting the fact that you kind of need special skills, knowledge on the ground to make sure that your risks are managed and that in the end you achieve the returns you are after, as well as the impacts you're after. And then in terms of OMI, talked about the fact that our investments kind of fit in with those discussed in the GIN spectrum of investing, and our focus being housing, education, and financial inclusion. Delivering of impact is aligned with the SDGs, as I mentioned earlier, and then focus being on education, decent work and economic growth, reduced inequality and sustainable cities. And the fact that there's also a focus on driving transformation and gender equality across all our investments. And then I guess the key message is the tremendous scope of investment into sectors and market segments where you have this kind of dual mandate and able to kind of move funds into areas where social impact is sorely needed. And the fact that you can do that as well as achieve decent returns. And then Kelly Joshua discussed 2 case studies in the education space, the one being the Royals. And excuse me, I'm just going to... And in the first case study, capital was utilized to grow a small business. So initially they had 750 learners, and over a period of 8 years have grown that to over 5,000. And then the other deal was Batseta. It's a smaller deal. The key impact came through the implementation of governance structures within the business, and just kind of helping the business develop into a more sustainable position. And both examples, just reiterating the point again, in both examples, they've achieved financial targets and have consistently improved education outcomes. And then just to end off, sorry, I know it's been long. Just to end off, there was another poll around impact investing, and 36% of the audience said they made an allocation to impact, an impact allocation. 36% said they knew enough about impact investing and were considering making an allocation. 29% were interested in impact investing, but needed to know more. And then thankfully 0 were not interested in impact investing at all. Thanks so much. I know that was a bit of a mouthful, but that was our session.
Thank you so much, Tanya, for that nice summary of Solution Room 5, leveraging alternative investments as a tool for impact. We're going to quickly move on to Solution Room 6, where the topic for discussion was social impact investing and creating a positive effect from it. I'm going to ask Motlatsi of Momentum Investments to give us a summary of that solution room. Motlatsi, over to you.
Thanks, Radesh, and good afternoon, everyone. Thankfully, I'm the last presenter, so you don't have much to wait. And also, thankfully, there was only one presenter in Solution Room 6, so I'll only be going through one presentation. You can all thank me later. So we were obviously discussing impact investing, particularly from a social perspective. I guess a lot of the things that we discussed here are very similar to the earlier discussions in the other rooms, and also with the infrastructure teams in the other rooms, 1 to 3. And that's obviously follows simply because we kind of implement social infrastructure via infrastructure. So more or less the same kind of issues turn up, and we're discussing more or less around the same kind of themes. So this is no different. So we talked quite a lot about the why, what, how of impact investing, starting with actually defining what impact investing is. What does it involve? And in essence, obviously, impact investing is quite different from the other sustainable investing strategies, such as responsible investing, social, corporate social investing, ESG, and so on and so forth. We talked about how it's evolved from what was previously SRI and how it's come along up until these days, and what the intentions are. And particularly the fact that there are 3 main features that are unique to impact investing. Those being obviously intentionality, the fact that you invest there because it's not incidental, it actually is what you set out to do from the very start. Show additionality, that's to say that you need to, first of all, be able to measure it, and also by measuring it, be able to prove that your investment has actually added on. Sorry about that. Your investment has actually added on to the overall outcome. So without your investment, the outcome would have been a lot less. So you can show the additionality from this perspective. And thirdly, that there actually has to be a financial return to it. So this would be different, obviously, from the other types of returns in this area, where a financial return is not necessarily a priority, or sometimes there even isn't an expectation of there being one. Then going on to the whys, why would anybody invest in infrastructure? The main reason, I guess, is because pension funds, trustees, asset owners, in essence, want to be able to operationalize the impact objectives, right? So they may have a specific requirement that they wouldn't be able to achieve in other markets, like, for instance, listed equity or bonds or cash. So they use impact investing in this space, which is essentially and almost always the private markets, to operationalize it and put it in effect. So that's generally the main reason that they tend to do that. So they're able to structure very bespoke and personalized impact objectives, and then look for ways then to implement this by putting on, an implementation, measurement, and management strategy over and above that. We spoke also just in the how space. We talked about the government's economic reconstruction and recovery plan, and that was to, in essence, talk about what's happening in the infrastructure space and where the opportunities are for investors to participate and actually use what's already available there to implement their impact strategies in the market. And in essence, this is obviously about the prioritized sectors, and we only focused on 4 for this purpose. So we talked about the reforms that are happening within the electricity space. So in other words, the restructuring of Eskom and what the implications are for that, which long term we anticipate that it would lead to effectively a free market in trading and in generating and trading of electricity in the long run. So these are almost like the build-up steps towards that. We talked obviously about the other events, initiatives that have been happening in the recent past. For instance, the embedded generation increase in the limit there. We talked also about, in the municipality space, about municipals now being allowed to also, in essence, trade electricity, or be able to, at least to determine their own policy around electricity purchase and generation. And well, we touched very briefly on, what's happened to infrastructure, I guess, specific to pension funds and the allowance, obviously the reform from that perspective. We spoke a little bit also about the projects that have been identified by the Infrastructure and Investment Office within the presidency, and what the impact of that is, obviously, in bringing projects to the market, particularly to make them bankable projects, as a way of, I guess, mobilizing private sector funding for those projects. Right. And then we talked about the different approaches to impact investing, right? In terms of differentiating it between investing with no intention. So effectively, you invest and hope for the best. And then investing with intention. So you say, we would like this kind of social outcome, or we would like this environmental outcome. So it's phrased in very broad terms, and almost the intention is very, you can't really pin it down because there are no measurables to it. And then the last bit, which is obviously evidence-based impact investing, which means that not only are you deliberate, but you also put very specific targets to it in terms of exactly what you're looking to achieve and what you'll be measuring, the timelines over which you'll be doing that, and obviously then defining along those lines what success is, and what not reaching success means too. And then we talked about practically about how do you actually introduce an impact strategy to your whole investment, to your investment. The kind of approach that we used is I guess along the same lines as the theory of change, which in essence means that you're looking at, well, we'll come to the theory of change now, but the kind of approaches first that you can take, which is you can either do it yourself as a board of trustees, or you can do it as an investment committee, or you can outsource it, right? You can get a manager to do it on your behalf, or you can invest in a fund that does it for you, any of those. Or if you do it yourself, you can bring in consultants or somebody who can, alongside you, move you on that journey, show you how to do it and what best practice is in that. We spoke to you around the challenges around this and the complexity of this, and obviously there are three main complexities around that, or at least challenges to that. The first one being the fact that there really isn't a standard, so it's not standardized in any way. So the ways of measuring it, even defining it sometimes is not, there isn't a standard template that you can use. So that tends to discourage some people in a way, simply because it just seems a bit out there and not necessarily practical or implementable from their perspective. The second one is then, the second challenge is then around the cost of doing it, the cost of actually implementing it, because now you actually have to go and gather the data. You then obviously have to analyze the data. And all of these things, and then obviously you have to then get tools that you can use for some of this. And obviously some of those are specialized tools. So there's an extra element of cost that goes into it, additional cost that goes into it. And ultimately you then also have to report it in some way or another. So all of this adds up and can actually be a disincentive, I guess, for people who are borderline and are still deciding whether to go or not to go that way. And then thirdly, then is obviously the time horizon of impact investing. Impact investing, like most thematic investing strategies or alternative strategies in general, tend to be obviously long-term themed investment strategies. So everything always takes a while for it to manifest and for it to get to a stage where it's actually verifiable and measurable in a credible way. So those kind of things also can be discouraging for some people, that you can't exactly show results in 3 years. Maybe you need to wait for 5 years or maybe even longer before you actually have credible results that you can then, start plotting and making decisions on those. We spoke about some of the tools that are available for measuring. They're quite obviously, and I guess the messaging was that it's come quite a long way, where initially people in the space used to do their own measuring. So they'd be running spreadsheet measurements of this and running, doing their own calculations. But now the industry has evolved quite significantly, where now there are actually available tools, which are actually quite credible tools to use and are very user-friendly tools. And they can actually, some of them are basic enough, rudimentary enough to actually achieve your objective of being able to monitor and quantify. You also have quite advanced tools that can go more in depth and give you a lot more detail and a lot more nuanced output in terms of what you've put in. So Iris Plus obviously is the most popular one that most people know of, but there obviously are others such as Pulse. Some people are still obviously relying on the operating principles of impact investing and some of the other IFC tools. So there actually are quite a number of tools that are openly available in open infrastructure arrangements where anybody can actually access those free of cost and then be able to amend them to suit your own purposes and things like that. Now, why it matters. We ran a bit of a poll just to work out how many of our audience are actually already implementing impact investing strategies. And it turned out that a third are already doing it practically, while the rest are still investigating impact to see how they can implement it and how it can work out for them. So that was quite interesting. So why it matters? Well, there are a number of reasons why it matters. The first one obviously is that you can use it as a negative screen. In essence, what ESG is, right? So you can use it to understand what your risks factors are, and obviously then how to manage those or at least avoid those from a negative screen impact perspective. But I guess it should be noted that obviously, impact investing and ESG are not one and the same thing. So that should always be clear that you can do impact investing without necessarily doing ESG, even though obviously they go hand in hand. It makes sense, but they shouldn't be confused for one and the same thing. And then the second reason that it matters is obviously that there's market demand for this kind of information. So investors want to know what their capital is being used for. So not just from a financial return perspective or financial investment perspective, but also what kind of impacts are you leaving behind in your community? Because each investment obviously has a private, or at least the private market investment has a private impact and it has a public impact. The private impact, we can measure that easily because that's a return that you generate. So we know what that is, and we know the risk that goes along with that because you can work out what the volatility is, the standard deviation and all of that. But there are also public outcomes that are not necessarily measured sufficiently, and this is where the gap is. So what do we need to do then as investors to be able to understand that missing link, to understand, in a verifiable way what impact our investments are having on society, communities, and the environment. And then lastly, then what also that because there's guidance now actually, so there's no excuse why we shouldn't be doing it as investors. There's guidance out there that's available on how to incorporate impact investing in your whole risk management framework, how to report on it, and how to actually make it part of your whole investment process. So those are, in essence, I guess, the high-level reasons about why it matters. Specifically about why you should measure impact is, I mean, there are three reasons also here. The one is to prove that you actually are delivering on your impact objectives. So in other words, it's doing exactly what you expected to do. Secondly is to improve the methodology and to improve, I guess, the general framework around measuring impact. And then thirdly is to disclose, which is, I guess, the reason that I mentioned earlier, that you need to be disclosing all around, so in a comprehensive, a complete way about what your investments are doing. And then we discussed what most investors are doing, just almost like a snapshot of the layout. And a lot of investors are obviously doing ESG as kind of like a first step into impact. So ESG, they're monitoring what boards are doing, monitoring, the salary policies of companies, empowerment, implementation of empowerment regulations, equitable employment and remuneration, all those kind of, I mean, a lot of investors, institutional investors are already doing that. But in essence, that's kind of like a first step in this journey. And some of them are already assessing the difference that they're making. So there are other investors who are further along the line, and they're already assessing, measuring, and can almost like definitively and confidently say what impact they are making all around. And a lot also are aligning and mapping impact outcomes to the SDG goals. So a lot of them have translated that into what it means relative to the SDG goals, which obviously makes sense. It also makes it a lot more practical. And I guess it's like ESG is also a very simple way of just saying, this is what I'm doing, this is what the long-term impact or the long-term effect that I'm hoping that will have in general. Right, so just coming back to the theory of change, so in practical terms, as in what does it look like to actually run an impact strategy as a fund? And the theory of change is a nice framework to use because it kind of like maps it out like you would, in essence, like any investment strategy that you want to implement. The first one being that you want to plan for it. You want to understand what it is that you want to measure. So you want to define very well what your strategy is going to be, what it intends to achieve, and how you're obviously going to measure it. So define what matrix you're going to follow and monitor. The second one then being obviously the doing. So now you've done the planning, now you actually do the doing. So which means how do you then allocate resources to that strategy? What's your timeline that you're going to be investing in it? The resources that you're going to allocate to it? And the kind of activity that you expect that you'll be able to support and encourage in that. And then the last bit of it then being the assessing. So you assess and review. So this is where you look at then your short-term outcomes, your short-term results, and if it's in fact what it is what you're looking to achieve. And as time goes on, then you look at obviously at the medium-term and longer-term results of your activity, and obviously being able to collect the data and be able to store the data and be able then to obviously be able to draw out a nice time series of the results that are coming out of your project. So that's quite a obviously this is just high level, but it's quite a detailed with steps along each of those on what you should be doing, what you should be considering. But it's I guess a very suitable framework to use in terms of actualizing this and making it real. And then finally, we looked at a video of the student accommodation facility that Momentum Investment has invested in as part of our social impact investment strategy. So that's a facility out in Hatfield that's been operating now for about 1.5 years. So we're just looking at what that facility looks like. what the actual experience of people who live there, the students who've moved in, what the experience has been. And I guess how it's kind of like changed their student life and allowed them, a lot more freedom within a secure environment to study in. Okay, that's it, Radesh. That was us.
Thank you, Motlatsi. I think that was a really enlightening summary of Solution Room 6 for us who didn't attend. I think you've provided us excellent background. We're not going to let you off the hook as yet. We've received 2 questions from the audience. I'm just going to mention the 2. They come for Solution Room 5 and second one for Solution Room 6. But let me start with the first question. With regards to alternative investments as a tool for impacting investments, the question was whether it makes sense to actually use some of the traditional asset classes like bonds, etc., instead of alternatives like private equity or venture capital in respect of impact. Tanya and the panelists in Solution Room 5, I'll ask you to ponder over that. And then the second question with regards to Solution Room 6, Motlatsi, on social impact investing. The question relates to where from a fund's overall portfolio would you see such impact investing coming from, and would such impact investing have to detract from returns, etc., from the more traditional asset classes in which retirement funds invest? So with those 2 questions, I'm going to first ask Tanya and the panels in Solution Room 5 to give their views with regards to the first question. Tanya, over to you.
I'm hoping that one of my other panelists are able to answer that question. Not throwing anybody under the bus.
Hi, Tanya. Etienne here. I can give some color to it. I'd be interested if any of our other colleagues here can add to that. But from my perspective, I'll give some color. So you are increasingly seeing green bonds and social impact bonds and various other kinds of bonds becoming more and more part of the impact and infrastructure landscape. And I think they do different things, and both things are necessary. So kind of your more typical private equity and venture capital style funds are very necessary in terms of the developmental stuff. So impact is to a large extent about development and additionality. I think one of the speakers used the word additionality. And those things tend to need private equity style or venture capital style type funds. The bonds, the green bonds and the social impact bonds and those kind of things tend to be more for the refinance of developed assets. So they don't necessarily lend themselves that well to the development of the actual assets. But that having been said, both components are necessary. People who develop assets also ultimately need to exit them. And there's various ways you can exit them. You can sell your stake in the asset to your partners, or you can sell it to a secondary buyer, or you can refinance out with a bond of some sort. So I think the answer is yes, but it is important to understand that these things do different things in the ecosystem, but that both are needed. Obviously, also bonds have a different return profile than the more kind of classic private equity or venture capital funds, and a different risk profile. So I think it's a matter of appetite. Do you want to pursue the more direct impact and potentially higher returns, or the kind of secondary impact and maybe the lower risk low return profile. So that's what I can add. Hope it was helpful, and very happy for any of my colleagues to jump in if they've got something to add.
Thanks, Etienne. I think that was most helpful. With regards to the second question on where does a retirement fund give and take in its overall portfolio, Motlatsi, I'll ask you to answer that question.
Yeah. So there were two questions, if I remember correctly. The one was the where, which is what you just mentioned now. And the other one was just what do you have to give up if you want an impact outcome. The first one, I mean, Etienne just spoke to that, so thanks, Etienne, for answering that for me. And that is that in the impact space, it's most natural to do it in the private markets. All right. So and I think, you know, in our session we covered that why you would want to do that. The first and most obvious reason is that you're closer to the actual investment in the operating asset, right? So you can actually direct it to something that you have better control over and have some lever in essence. Within traditional markets, within listed markets, it's a lot more difficult. So that's the first reason. The second reason is that the nature of these investments, as I said, because they're kind of long-term themes, investments, is that they tend to be more private equity-like, right? It takes a long time for the strategy to actually deliver. It takes a long time for effectively the seed to grow. So, you know, it needs a lot of patience, which is not something that's mentioned in the same breath as listed markets. So that's why private markets make a lot more sense for impact and impact-driven investing. However, having said that, there's actually no reason why you cannot introduce impact themes to your other mandates, to your traditional mandates. So ESG as an example is one instance of that. ESG is obviously a component of sustainable investing. So in introducing ESG or monitoring of your investment companies and the managers thereof is in a way, I guess, a first step towards doing that. And then secondly, I think we are slowly but certainly making our way to a point where the mandates that you give out to your fund your equity managers or your fixed income managers will at some point start introducing elements of impact investing. So beyond just, but also about, you know, what are they doing to the environment? What are they doing to, or at least being proactive, not just reporting about what's happening, because that's more like the ESG bit, but also being more proactive about investing in the right technologies, investing in the right kind of operations. And by right, obviously, that's where then you can give your input about what exactly you define right as. So there's no limitation, I guess, or at least you still have some avenue, I guess, even in listed markets, to start implementing impact kind of strategies, or at least impact themes within that. On the second question about what do you have to sacrifice for impact? Now, I mean, there are a lot of views around this. You know, I think if you backtrack a little bit and look at how we've evolved and where it's come from, impact investing has always been around, or at least about, social outcomes to the detriment of financial return, or at least historically, right? So you kind of did it as part of your portfolio, but a very small part of your portfolio, because you kind of like we're looking at it as almost like charity work, right? Where you're helping communities, but you're not really expecting a return on that. So historically, that's always been the theme of it, and I think that's almost like an image of it that's going to be difficult, I guess, to overcome. However, I mean, in this environment, things have changed quite a lot. There's been a lot of evolution, and there's been a lot of change in terms of how the strategy is implemented, to the extent that for some of these strategies, the delivery is no different from what you're actually generating in your other strategies, in your equities strategies, for instance. I mean, to give you an example, the example that I think we discussed in our solution room was renewable energy, right? So you invest in renewable energy also as an impact strategy. However, some of the returns that you're realizing in there are north of 20% IRRs, especially if you're in the equity bit of it, of the capital structure. And it's not just in renewables. I mean, there are obviously other areas where it is very possible to do that. If you look at, for instance, water projects, or at least the few water projects that have been around and the returns that those have been able to generate. Other alternate energy sources. So if you look at investments in, say, for instance, gas or even biomass, for instance, the few projects in biomass that are around, particularly the captive client ones. I mean, the returns there have been comparable, if not even better than in listed markets. So I guess the image, or at least the argument that this is charity work and you actually are having to sacrifice something for that, I think that can comfortably be put to rest. It obviously all depends on the kind of projects that you're investing in, the kind of where in the capital structure you're investing, and I guess the returns will match that, right? So it's about implementation, and it's about, I guess, understanding all around what the actual opportunities and what's available from each of those opportunity sets. Thanks, Radesh.
Thank you, Motlatsi, for a very comprehensive answer to that question. Much appreciated. And thank you, Etienne, as well. I haven't seen any further questions, or haven't received any further questions for our three final solution rooms today. So I'm going to take this opportunity now to thank all the panelists who've debriefed our audience this afternoon. Thank you for comprehensive and well-explained summaries of each of your solution rooms. It is greatly appreciated. What's left for me to say is I hope our attendees enjoy this evening and wake up fresh and early in the morning to join us for day two of our solutions room. We promise that it's going to provide even more insightful and enlightening discussions on burning issues that face retirement funds in this country. And I wish all of you, if you're traveling, a safe drive home today. And if you're at home, enjoy your rest of the day with your family. And we look forward to seeing you bright and early tomorrow morning for day two. Thank you, everyone, and goodbye.